Well, still on the subject of inflation, the Bank of Ghana has indicated that it expects inflation rate to slow down by September despite current developments in the economy, as May inflation rate reached a record high of 27.6%. There are projections that prices of petroleum products and transfer fares will go up significantly in the coming days. Now, this has raised concerns about earlier projections that the rate of increase for inflation will start slowing down by end of the third quarter of this year. Philip Abredu-Otu is head of research at the Bank of Ghana. He has been speaking with my colleague, George Afe.
It's a marginal slowdown. But if you recall, I think the governor did indicate at his press conference that we are expecting inflation to peak somewhere around June, July. Yes, the latest numbers also came in a little bit strong, almost equivalent to what we saw in April. But I think the numbers will come down. It cannot continue forever. Monetary policy will begin to work. Our discussions with the meteorological department and the data that we are seeing, the rains this year look a little bit better than last year. And given the rains and then the temperature combination, I think the forecast is for the food situation to improve as we move into September. So as we move into September, we are likely to see a somewhat improved situation with monetary policy also working alongside to contain the non-food aspect, and we should see the numbers beginning to come down.
Do you think that this informs your judgment and even in the communication in telling the market that, listen, we don't want to run after inflation, and therefore let's really be careful in putting pressure on the monetary space to react immediately the rates are going up?
No, but see, if you look at what we did at the last MPC, it is clear we were not running after inflation. Because if we were running after inflation, we probably would have done the full haul of the change in inflation plus an extra. We did not do that. That would have meant that we should have gone up by some 7 percentage points. It tells you that we are looking at other factors aside inflation, and it's not wholly inflation driven.
I mean, whilst you want to be careful about not having too much squeeze on the market, what else are you also doing to deal with the offshore confidence bit because of the real returns on their investment and what the spike in inflation is going to do to them?
We do interact with investors a lot. In our last interaction a month ago, I think the offshore investors are aware of the situation. The offshore investors did indicate to us that inflation will be going up. They were even a little bit more bullish on inflation than we were. When I say bullish, in the sense that they thought inflation would be rising a little bit higher than what we saw. So in their calculus, they know they will have to live with some negative real interest rates for some time to come, and they factored all these things in their calculation. Actually, looking ahead, these investors told us that they are confident that come next year, if we are able to hold the current tightness in monetary policy, inflation will be slipping down very fast. I think the onus on the central bank is to ensure that we don't lose the guard and that we continue to maintain a tight monetary policy stance to ensure that when the benefits of a fall in inflation is coming, we'll get it more deep and get inflation slide down bigger.